So, what are the key indicators to identifying a bull market? As an investor, you shouldn't rely on a single indicator to identify a bull market. Using a combination of indicators to conduct thorough research before making investment decisions is key to taking advantage of rising prices in a bull market. Here are some of the common factors of a crypto bull run. Number 1. The price trend. A sustained upward price trend is one of the most apparent indicators of cryptocurrency bull market. This can be observed by looking at historical cryptocurrency price charts and noting an upward price pattern over an extended period of time, whether it be weeks or months. A variety of technical indicators such as moving averages, trend lines, and chart patterns can also be used to identify potential bullish signals in crypto price charts. Number 2. Trading volume. Bull markets are often accompanied by increasing trading volume and on-chain activity, indicating increased investor interest. Investors can spot the increase in trading volume on cryptocurrency exchanges and on-chain data to identify increased demand for cryptocurrencies, potentially signaling a bull market. Number 3. Market capitalization. Crypto bull markets are often associated with an increase in total market capitalization, the total value of all cryptocurrencies combined. Market capitalization can be assessed using an on-chain data analysis tool, such as CoinMarketCap or CryptoQuant is a good place to get this data. Other on-chain metric investors can refer to identify bullish assets include total value locked, or the TVL, which refers to the total amount of cryptocurrency locked in decentralized finance, or DeFi protocols. It can be used to estimate the overall demand for our particular blockchain, tokens, and protocols built on top of it. Similarly, the number of active wallet addresses can indicate the usage of a specific cryptocurrency. Additionally to that, monitoring the on-chain activity of large holders or whales can provide insight into market capitalization trends. For example, if whales accumulate a particular cryptocurrency, it may indicate that they're bullish. However, relying on this information alone wouldn't be wise, as whales may also deliberately try to mislead people. 4. Market sentiment. Market sentiment refers to investors' overall attitude towards cryptocurrency, which can drive cryptocurrency prices higher. For example, if investors are optimistic about the future of cryptocurrencies, they may decide to acquire cryptocurrency as part of their portfolio. During a bull market, there's often a general sense of optimism, with the crypto ecosystem expressing bullish views. Positive news, such as institutional adoption of cryptocurrencies and technological advancements, can attract even more investors. Number 5. Exchange inflows and outflows. Exchange inflows and outflows refer to the movement of cryptocurrencies into and out of the cryptocurrency exchanges. For example, increased exchange inflows may indicate increased selling pressure and potentially bearish sentiment. This may suggest that more investors or traders are depositing their cryptocurrencies on exchanges, possibly to sell or trade. Conversely, increased outflows from exchanges can suggest decreased selling pressure and bullish sentiment. It may indicate that more users are withdrawing their cryptocurrencies from exchanges, which could mean that they are holding onto their assets for the long term by moving them to cold storage for safekeeping. However, it's vital to use exchange inflows and outflows as part of a broader analysis when assessing the state of a crypto market. If you found this guide helpful, give it a thumbs up, share it with your fellow finance and crypto enthusiasts, and don't forget to subscribe for more interesting videos. Stay curious and keep learning.